Ladies and gentlemen, back in his regular time slot is Sean Udell, tech trader. Good morning, sir.
How are you doing?
I'm doing quite well. Thank you very much. How are you doing today? It looks like you were a little busy buying today.
Yeah, I mean, I think it's, here's the only thing I don't want. I don't want a lockout rally. A lockout rally is very typical after a sell-off like we've had right now. But hey, if we have one, they have one. I mean, as you've seen, I haven't sold a single position into the decline. They're pared down positions mostly, except for a few names. But I don't want a lockout rally. I think we texted a couple times before coming on today. You said, well, what was on my mind? What's on my mind is what is the least likely outcome or the least likely thing that people are expecting. I think the least likely thing is to have a surprisingly strong rally from yesterday's lows. So we'll just have to see what happens. But I mean, I talked about sentiment a week ago. Those sentiment numbers got lower. I even posted some to my Twitter, my Twitter feed. Posted some numbers, some charts literally yesterday morning, and looks like we got a pretty good sentiment low because I don't know if news was a whole lot better today. Maybe news was just as bad as it could be yesterday. I mean, it was just funny. I was sitting here watching this yesterday. Okay, so overnight futures down big. On fears of Google. I actually didn't think the market would react to Google very negatively. Wake up, futures not for kind of, down but minorly, stuff traded fine, and then Facebook hit. And Facebook really put a crimp in anybody who was buying. And then, that wasn't enough. I mean, we didn't really bounce. We sort of just stabilized, and then boom, Apple hit. And so, I don't know, maybe that's about as much bad news as you can kind of like get in any one day after, what is relatively 3 to 4 weeks of sort of bad trade news. And, that what I've always said, the best scenario is when you get stocks to hold or rise, in the face of bad news. Now, they didn't necessarily rise yesterday, but they're rising today. And again, hey, the threats against Google and Facebook and Amazon, haven't been repealed today. We don't have a China trade deal. We don't have I haven't seen any good news on Mexico. So, stocks are bouncing pretty big. Maybe we digested a lot of bad news. Sentiment readings got very low. They didn't get to December lows. And again, December lows were literally like 5-year, 7-year, 10-year type lows. So those lows don't occur very often. But we got to lows we typically see 3 or 4 times a year. When the market's correct anywhere from 5 to 7 times a year. I don't know what's the average stat. You have X number of 5% corrections per year and X number of 10% corrections per year. Here's the difference. The difference now is almost every single correction we get, even really mild corrections like 3-4% index corrections. Almost every correction now feels like a crisis for the average stock. It's just that's market structure. That's the lack of specialists, no uptick rule, the age of algos, the age of machines, buyer's strike, low liquidity, blah blah blah. It's the same thing. So every correction, whether it's a 3.5% index correction, a 5.5 or a 10, they all basically feel the same to kind of the average stock. So that's why I'm not a big believer in in using stops. By the way, I'll put stops on for people that like them. I'll put them on my posts from this point. But if you're trading tech can move 30% for no reason. It can move 50% if you have a reason. Biotech even more extreme. Energy about as extreme. So the bottom line is, these things move in huge, wide swaths. And a lot of times the price action doesn't really mean anything. And I'll close on this. Twitter. The single greatest thing for Twitter revenues that I can absolutely imagine would be if Facebook and Google's growth or market dominance or ad share was in some way, some minimally way, curtailed because the ad budgets are basically going to stay the same. So you're going to have to, deploy ad budgets to farther down the food chain. Now, Facebook is a pretty firm, I guess, number 3 in the internet ad space, but they're a tiny, tiny number 3. I mean, Facebook is doing 20 to 25x Twitter's annual revenues, which means Google's doing 40 to 50 times X Twitter's annual revenues. If Twitter were to pick up just a minute amount of share from each of those players, it might be a doubling of revenues. It literally might be a doubling of revenues, but it's like, yeah, I'm talking, basis points of market share for Google could be 400 million in revenue. 20 basis points, 30 basis points in internet ad share could be 800 million in annual revenue for Twitter. So yeah, what did we see yesterday? Okay, age of machines, rise of the machines. We should write another Terminator script. Twitter was down almost as much percentage-wise as Google. 100% just idiotic price movement short term. But that's what we have now. So if you're going to trade individual stocks, you have to steel yourself to stuff like this. And you probably have to have higher than normal levels of cash most of the time. So you can take advantage of things like that if you so choose. But that's like that's probably one of the most clear-cut examples of literally just lunatic price behavior that I can point to just directly, which is literally 180 degrees opposite of the fundamental, what should have happened fundamentally. I mean, put it this way: if I put my old hat on, and we're pre-2000, third quarter of 2007. When they eliminated the uptick rule. So let's say this is 2005 and Twitter existed. They didn't. Twitter would have been up 10% on that news yesterday. Pre-uptick, pre-algo world, Twitter would have been up. I don't know. Twitter might have been up 15% on that news yesterday. Again, there wasn't a Twitter in 2005, but there is a Twitter today. I think Twitter could benefit mightily. Again, I don't see these Google and Facebook things going away. I don't know if the DOJ is going to go absolutely full-fledged Microsoft on them or Standard Oil on them or whatever. But I don't think this thing's going to go away. I see literally zero reason to own Google and Facebook at current prices. I think they're going lower. I didn't like the stocks before. They were the FANG culprits last year, which has led and morphed into the cloud culprits this year. But the prior leaders always lag in the future. So this is a great example of if you're chasing the prior cycle leaders, you run into problems like this. I think Google and Facebook are going to struggle. Yeah, if they get low enough, I might look at them. What was my number on Google before? 800 to 900, something like that. I don't know if I'd have the same range now on Google. I don't think it sets up as a great risk reward for long-term holders. I mean, this thing could go on a long time. And yeah, the big talk is, oh, hey, you break Google up and it's worth twice as much. Well, that might be true in 4 years or something, after all this plays out and after you actually get breakups and spin-outs. I mean, I firmly believe that. In fact, that was one of my things. I wrote a piece many years ago. Basically, my long-term price target in Google was 3,000, and I think the stock was, I don't know, 500 around. And this was a pre-split. But Google hit it. Google hit the target, and one of my big thesis points was the value of all the underlying businesses were way higher than what is captured in the current stock price. The problem is you're not going to see that until you actually get spin out. But then different businesses could be curtailed too. That's the other thing you don't know. Anyway, I'll stop there. But, I think we got to a point where things got, what was the comedy, Dumb and Dumber? We were into the dumber category yesterday on a lot of price action.
All right. I can tell you where my levels would be on Google. That would be in the 900, 925 range. That's where I'd be sniffing out a reload there.
Yeah, I mean, that probably works for a short-term bounce. But it just, this is not good. I mean, I remember, hey, the Bulls tried to argue how great Microsoft was and even curtailed blah, blah, blah. Well, I don't know. It took a long time for Microsoft to really get going again. That wasn't all government action, though. You had a lot of really poor decision-making by the former CEO, Steve Ballmer. you know, just so many bad M&A deals at bad prices. I mean, the M&A stuff they should have bought, like oh God, they could have, I mean, they could have bought Yahoo, which would have been a great deal. They ended up not doing that deal, and all the deals they did were just literally throwing billions of dollars. You might as well just lit billions of dollars on fire in a bonfire out in Seattle. You know, I haven't seen them do a lot of great M&A since Nadella took over, but LinkedIn was a solid deal. And, you know, I think they've done some smaller bolt-on deals, which have been relatively good. And the main reason Microsoft's gone up is they changed their subscription model. So they basically followed the Adobe Autodesk kind of deal, went subscription-based, and it's boosted the stock a lot. So, you know, that's another one. By the way, Microsoft's already gone through the DOJ water torture test, so, you know, I don't think they're much at risk. So anyway, you know, we'll see what happens, and yeah, I mean, Google might work for trades, but I just don't know. I don't think it sets up as a good risk reward until you get some kind of resolution. Now, this could be politics too. This just could be kind of politicking, setting up next election cycle, setting up talking points, things like that. We don't know. We'll have to kind of see what plays out.
All right. Before we get too far away, just let the listeners know what is a lockout rally, because that's a term that not everyone uses. So just give them a quick little definition of what you mean.
It's a rally that kind of gaps and goes and takes off, and I guess doesn't have big fades and pullbacks to buy in you know. So
think of it like a stock squeeze, where it just keeps running higher and people are chasing, and then the fear of missing out comes in, and you don't get the pullback, you don't get the consolidation, you don't get the type of things that you want to see in that. So hopefully that helps.
Yeah, you don't get retest action. You know, you don't retest the prior lows much. I mean, maybe a couple stocks do, but for the most part, most don't. You know, again, it's kind of a gap and go that keeps going, and you know, so I mean, so far that's it. I mean, I didn't know it was going to happen, but I kind of, like, the first thing I thought of this morning is like, okay, so here we are now. What's the least likely? Like, what's the thing that the largest number of people would not believe? And that's you probably have a lockout type rally. And so that's, again, the machines love doing it too, because it's the perfect counter to the kind of negative price action we've had, you know, in recent weeks. By the way, there's a lot, you know, sometimes I'll take pain. I take drawdowns, but, you know, you get a big bounce, and if you have most of your inventory that you've taken the pain, once it bounces, you can recover a very large drawdown very quickly, and on just a decent bounce in quite a number of stocks. So, you know, everybody has to find their own style. I mean, this works for me. I mean, I've been light though. I mean, I've talked about that. I mean, I've been relatively bearish probably since like the March highs. So, so now, you know, now I'm feeling like, okay, now we might have a setup where trading gets better. Some price levels are still very ridiculous. By the way, just because stuff goes up 3 or 4 or 5% doesn't mean it can't go up 30%. So, you know, I think somebody asked, I'll preempt you, somebody asked a question on PSTG. I used to follow that name years ago. In fact, I think I was long that name. I don't know, I want to say around $10 probably in 2013. I kind of got off of it. I just it never really did what I wanted to do. And I'm trying to remember, there was a certain, like, names like Marketo, Demandware has been bought out since. Marketo's been bought, but I basically kind of morphed into some of the newer, I call them basically the post-2016 IPOs. So, I mean, hey, there was a point in time where all the names, they're the hottest names now, I was long all of them. But instead of being long them at 126, I was long them at 26. So Coop, Twilio, Okta, Mule, blah, blah, blah. I mean, there's like 4 or 5 other ones. So, so pretty much once those names came out, I said, look, all these names I think are far. NTNX was the one I built the largest position at one time. So, you know, once all those names came out, I pretty much said, look, all these names are better names. I like them better. I like relative growth metrics better. I like relative value metrics better. They might have much higher growth rates. They're beating quarters by bigger magnitudes, et cetera, et cetera. So like right here and now, While they didn't have the greatest of reports, I think the punishment's so much worse than the crime. Like something like a ZUO, which is up 6% today. Again, that's nothing. It was down 30-something%. So you need a 60% move to get back to where it was. But something like a ZUO, I'd favor over Pure Storage. NTNX at 2750. Like I'm kind of waiting, just so you know. I'm kind of waiting for like 25s on NTNX. Hey, if it locks me out, it locks me out. I have a tiny position in it right now. I bought it at whatever. It was one that came down the last quarter. Bought it at 34, sold most of it at 42. Still have a tiny piece left. But you know, I don't know. I kind of have a feeling like that one. You know, earnings misses usually won't participate in a quote unquote lockout rally. They'll bounce a little, but then they'll kind of, you know, get sold. There's kind of a sort of a divestiture period of earnings misses now that tends to occur over a couple week period, maybe longer. So I don't know, like that's a name I definitely am circling sort of, you know, 25 and lower. I feel very comfortable in that. But by the way, I mean, I think they reported since we were last on. I really, you know, ZUO flat out lowered guidance. NTNX, yes, they did, but it's really, they lowered guidance because their subscription uptake is so big. In other words, I think what's happening is they're adding they're converting to subscription contracts way faster even than they anticipated. And again, that reduces short-term revenues by a lot. I mean, you're basically instead of taking a 1-year contract up front and booking it, you're taking a 1-year contract and you're ratably booking it 1/12 per month. That's a huge difference in short-term revenue. But you know, in some period, it's either last year, last quarter, something. They've gone from 41% subscription mix to 65%. I think so the last year. That's a massive increase in a very short period of time. So that's going to crimp short-term revenue, but enhance long-term revenue, and also make things more consistent, and probably generates higher margins and stuff like that too. So actually, I mean, if that would have been, it kind of reminded me of a Data, which is Tableau software report, when it was recovering off of 40, probably got up, I don't know, 60, 65, 70. It had a couple quarters like that where they knocked it down pretty good. But really, it was a very positive development because they were same deal. They were adding subscribers at a much faster rate, so their billings growth was way higher than near-term revenue growth, and it actually translated. You know, it takes about a 2-year period, or well, it depends on contract length. So if it's a 1-year contract, it takes 12 months. If it's a 2-year contract, et cetera, et cetera. So. But that's a very positive development. ZUO is just kind of a typical dumb weight overshoot. You know, they guided down 6%, stock goes down 35%. Again, if you think that's right, go ahead and short ZUO. I'll see you in a year, and it's probably a lot higher. So, you know, like I say, I don't overly worry about stuff like that too much. Again, very small position for me. I definitely plan on increasing it. I don't know when. Right now, I'd rather focus on, again, certain things I just sort of like near term better. But yeah, no, I mean, there's some interesting things going on. A lot of prices are cheap. I mean, I'm even looking at something like a Dropbox, same deal, kind of a small position in it, never done much on it. They're down on Box today. Dropbox had a very good quarter. In fact, I really, since they've been a public company, I can't really find a quarter they've produced that I've disliked. They're not a company that's going to really blow stuff out, but they pretty much delivered, and I think most of their guides have been pretty good. So again, we're just in a weird market. It's just we had these huge increases in Vive. I think Okta had a big spike up. They've given up a lot of gains since their spike highs, but you know, I mean, the Vive quarter looked like 20 other Vive quarters they reported, and so. Again, it got bold higher. You know, the Dropbox quarter versus themselves, I think, was every bit as good as what Vive just produced, and yet Dropbox has traded poorly. It's just, you know, we're kind of in a cycle. We're in a very small number of names. We talked about this. Very small number of names are basically kind of the cloud bubble names. They're popular. They're momentum based, and they've replaced the FANG names. So it's that same condition we've talked about, and so the market kind of hates value right now. I don't know how long it's going to hate value. And value is anything from absolute value, like just really, really cheap things on balance sheet basis, or it could be relative value, or it could be, stocks that metric well on relative growth metrics and things like that. So value is kind of anything that's far cheaper than peers, I kind of call value. But yeah, the market hates Dropbox, it hates CLDR, it hates ZUO, it hates NTNX, it hates BIDU. So
Hey, Sean,
things that are just. Oh, go ahead.
Yeah, so before we get too far away from it, I want to ask you, what's the difference between a stock, like some of the cloud names that you say are in a bubble, and stocks like Dropbox and CLDR and the like?
Well, just to conclude my point, because I was literally 2 words away. The phase we're in, if the market hates value and things get really extreme, you get to an extreme point and you typically stop or reverse. So we very well could be at that point. Anyway, as far as that means, that's easy. I mean, like, okay, Vive is 26 times sales, CLDR is 3 times sales. Now, hey, does that mean CLDR is going to beat the report? I don't know. No, it doesn't. Does that mean CLDR is going to start showing the power of the merger with Hortonworks? Not necessarily. Maybe not this quarter. I still believe that's going to occur. But again, CLDR is 3 times sales. Vive is 24 times. By the way, the reason I'm saying CLDR and Vive, their growth rates are roughly similar. I think last quarter, CLDR did core revenue growth with something like 22%, and Vive just did 25%. So hey, you tell me why Vive should trade at 26 times sales and CLDR should trade at 4. Well, I use out year. So on out year, Vive's about 19, 20 times, 22 times. CLDR is like 2.4 times. You want to use current, CLDR is like 3, and Vive is 26, 24. So again, that doesn't make sense. A lot of things don't make sense. But that's the difference. The difference is, look, I can identify companies with similar growth rates. Another interesting name that's kind of got back in my radar screen, if you will, is Tenable. That's TENB. I'm trying to remember what they didn't like about the quarter. I think it could just be they reported at a time when reports weren't going up on good reports as much as they were earlier in the quarter. But they beat. I think they guided higher, maybe billing. There was some little thing that somebody said they didn't like. It might have been a billings number was a little light, but that stock, it's not dirt cheap, but it's got 35-ish, 40% growth, and it's about 8, 9 times sales. It's pretty cheap out year. Out year is like 6 times sales. So that's something that I'm kind of looking at again. That stock, I don't know what was the high on that, probably 40 to 50. It's been cut in half. 40 was the high. So 25, not quite cut in half, but close. But that's the example. Is you just have, you have Vive, you have Okta, you have Twilio trading at crazy prices currently. I mean, hey, Twilio was cheap when I owned them. And it was still relatively cheap when I exited the position. So yeah, I mean, that's all the difference is. It's sort of like saying, like last year, NVIDIA, was part of the FANG group and was trading at a high software valuation. I think NVIDIA got to like 18 times forward. Well, it ain't there anymore. So, it's not quite been cut by 2/3, but pretty close. So, been more than cut in half. It's still not cheap though. We've talked about NVIDIA. It's 8 times sales. That's pretty spendy for a chip stock.
Is it really 8 times NVIDIA?
Yeah, 8 times sales.
Well,
it was 18 times sales.
Okay, yeah, but what's the industry running now?
I don't know. I'd say anything. The industry is probably a little higher than norm. But I mean, something like a Qualcomm, which I would consider pretty darn cheap, is like 3.8 times. But Texas Instruments is expensive. Different semis trade way differently too. Xilinx is probably Xilinx and NVIDIA are about the same. You know, Xilinx is taking a 40-point haircut. But yeah, so you know, semis historically, you know, I think expensive used to be like four to six times. So everything, a lot of stuff has re-rated higher. Some of it's deserved, some of it not. There's been a lot of industry consolidation in semiconductors, so that should, you know, that definitely increases margin. I mean, Skyworks, that's a name I continue to like. Don't have any, but you know, that's 3 times sales. And Skyworks margins are very good. Profitability is very good. Long-term market positioning is excellent. So, you know, there you go. I mean, should Skyworks trade at 3 times forward versus NVIDIA at 9? I would probably say not.
All right, let's get into...
So these are things you can take advantage of if you choose to.
All right, well, speaking of taking advantage of, you took advantage of some of the weakness that we've seen in BIDU, got involved in a trade lower, and then I guess you got in on a buy stop at 110. You moved that lower from yesterday. It was, I think you put in a buy stop at 111, moved it down to 110 today, so you've added to that position, I guess significantly, right? You said you were going to add to it or double it over the course of the next few weeks or so, but you find it very, very attractive down here at 110, 111.
Yeah, I mean, my mode on it now is to trade it short term, but keep pieces. So you know, I don't want to get too wonky, but I don't know. Let's say if I add a quarter, I might keep a tenth of the quarter or something, right? So I might build the position up sort of slowly over time, or I might just kind of let it go. I mean, I might just kind of let it run. I haven't sold any, so. I could take 4 points right now. That's not bad. In fact, a little more than, it's almost 5 actually off of lows, or where I entered it, because I caught it was, I don't know, it was maybe 30, 40, 60 cents under, I think, when I bought my first slug. So, yeah, I don't know. I mean, we'll just see. I think that, again, this is an overshoot. So, you know, how do you express a degree of something? It's very tough, right? Because charts are sentiment and news and all this stuff, but basically the price of a stock at any given point in time is more of a measure of emotion than anything else. I think the emotion has gotten extreme, and then magnitudes of extreme in a name like BIDU. And BIDU's not the only one, but I think that, you know, I still here. I'll give you the exact points, and I'll even put a post. This is what I posted this before. I know I have though. But if I look at, I'm just kind of mapping the gaps on this thing. So if I look at here, I gotta change my chart sizing so I can see this properly. So okay, you got a gap now, 115 to 118. I would almost ignore that, because any decent recovery, you're going to get this thing. You're going to get a burst move through 115. So maybe you could use the top part of that. So you got 118, 117, 118. The numbers I'm really focused on short term. So these would be potential trading exits of partial positions, or maybe anything I buy low. I might take off 90% of the trade at these relative prices, right? So 123, first one, 128, and 134. So those are basically gap, either gap highs or gap lows. The last gap would be 150. We actually like more like 150, 151. But I just, just use the number 150. So to me, the first move up, you're going to get a move to 115 to 118. Then we'll see. I'm definitely going to take, this trade today. I get 10 points. I'm taking most of it off. It might be half, could be half, or it could be 90%. Probably 80 though. I'd probably take 80 off. Then I'm going to watch it. Then I'm going to see. Then I'm going to look at charts and try to find my next entry on it. Could be a buy stop. Could be a retracement. And then I'm going to shoot for 123 to 128. That gap fill. So I actually think this could happen fairly soon. I think you know, I kind of said the same thing about Lyft. I think when Lyft we might have had a program the day Lyft hit their lows. If it wasn't that day, it was very close to the day. And what I said on Lyft is I think BIDU is going to kind of play out the same way. So pretty much said once the short-term charts turn, once you kind of get a candle, I mean, you know, just call it a morning star, a doji, reversal pattern, whatever. You know, I thought Lyft could make up ground pretty quickly. It actually took a little longer, but you know, the first 3-day move off of lows on Lyft, you got the stock from 48 to 57. So that's a pretty good move, right? It's higher now. You know, I think BIDU will probably kind of do the same. This is just kind of what most stocks do when they get to kind of an extreme, stupidly low that, you know, they kind of have to chop away. And then at some point, they kind of surprise people with a certain amount of upside. And so I think BIDU is going to probably end up doing something similar to Lyft. I don't know if the percentage increase would be, I mean, what's that Lyft percentage? I guess every 5 points is 10%. It's almost 15 points off of lows. I mean, that would be 30 points for Lyft. Well, but that basically would get you to 134. So we're pretty close. But yeah, that's kind of what I'm shooting for. Like, I think the first kind of recovery trades are going to be somewhere in that 118 to 128 period range. And then I'm just going to play with, you know, hey, what's the pullback? What's the correction? What's the market doing? You know, but it should become a pretty good buy the dip trade once it kind of recovers into that kind of 120 to 130 area. I think any 2, 3, 4 point dip is probably pretty viable from that point. So we'll have to see. It's still going to prove it. Guess what it's doing though today? It's right at the 5 EMA. The 5 EMA, it's pretty much right at it right now. So that's kind of proving to be resistance right here, right now. It's since it started to kiss this 5 EMA, hasn't really made much headway. So I don't know. We'll see. Maybe that's it. Maybe that's it for today. But then doesn't mean, you know, doesn't mean it's done. It's done going up. But you know, we'll have to see. I mean, next EMA I like to use is roughly the 10 EMA. That sets up about that's like 118, 119. So again, don't want to get too wonky, but this is the kind of stuff I think about. This is my stuff my technical system points to. By the way, my technical system gave me initial buy signal on it yesterday too, which is part of the reason I added today.
On BIDU?
Yeah, on BIDU, yeah. So initial buy signal is the weakest. My system generates 3 buy signals. Initial buy signal is the weakest of the 3. Yeah, so really what happens, you get an initial signal, and then if you get buy signal 2 and 3, those are basically confirmation points. So, you know, so that would be nice to see. You get confirmation, then things really get ripping. But again, this is a big overshoot. So overshoots tend, you know, they tend to be extreme, and then when they unwind, you know, the rapidity at which they unwind can be pretty fast. So, you know, we'll see. I mean, it's got you know, it's going to digest though. It's going to, you know, each of these little gap points is probably a short-term resistance point. So like 115 is probably going to be short-term resistance. 118 could be, 123 could be, 128, 134, et cetera, et cetera.
If you had if your initial buy signal was all the way down here, why did you get involved earlier and not just wait?
No, these are short-term buy signals. Heck, I had short-term buy signals on it at 168, and it did go to 184. And, you know, then it ended up, I mean, the thing ended up collapsing on an earnings report. So that's, you know, technicals work in the absence of everything else, right? So once you have news trumps technicals and everything resets. So everything either resets higher or they reset lower depending on the gap from the news. So news could be trade news could be earnings, news can be anything that's significant that makes the chart move in a large percentage.
Okay, got it. Let's touch on the other one you added today, BE, Bloom Energy. Same story?
No, this one really is just more, you know, I've taken, I mean, I don't even, almost lost count how many times I've traded this name. I've pretty much been working this name, I want to say since, was it December? No, probably January. So it's had pretty good moves. So, you know, the first time, you know, I got involved in it, you know, I probably took 30–40% out of it, and I went 60%. You know, I've kind of traded all these little shakeouts lower. you know, kind of buy it, sell it. But I mean, here I think it's a pretty good buy. I don't know if anything's at a durable low. But again, it's hey, it's at the 5 EMA. That's always a signal I like to look at, or always at least a point. I really like the candle formation on this. So again, you know, I look at all sorts of stuff. But you have a really extreme wick, I think 2 days ago, and so that set up a hammer. You got a spinning top the next day. Basically, you got a Morningstar doji now. So hey, if we declare war on, you know, trade with India tomorrow, a lot of the stuff might not hold. But if you know, if we don't get much news, and the technicals can kind of fulfill in the absence of news. This company specifically has had no bad news itself. They had a good report last quarter. Stocks traded as high as 15 fairly recently. So, you know, I mean, a Fibonacci retracement on this would be basically just what, you know, take the low and the high, recent low and the high. So, you know, a normal move would be either a 38% or a 50% move or something. You know, I'm kind of thinking 13, 50, 14 might not be that big of a deal to get to. Again, I mean, this could happen in 2 days. If you just get, you know, if people start chasing, you know, stuff can ramp pretty quick. So the algos are super vicious on the way down, but they're also super generous on the way up, or they can be. So, you know, we'll just have to kind of see. But this is more a little bit position building. I don't really have a time frame on this or an exact target. I'm just going to kind of buy it, increase it a little bit, see what it does. You know, I like the value. I mean, this is a really, really cheap. I think we've talked about this before. This is an exceedingly cheap stock on growth metrics. It's not a tech stock per se, but, you know, again, if I line this up versus sort of my the loved stock universe, it's trading crazy. I mean, you know, you can't even get to a comparable if you start comparing this with higher growth names. But so we'll just have to kind of see what happens. I do think that, you know, the growth runway on this is quite a few years. So, you know, that could be pretty good. And a lot of people think this is like a solar play. It's not. It's basically using natural gas efficiently, very low carbon footprint. But it's a very clean energy producer. Just so people know, you know, these are sometimes you go by these big buildings, you see these boxes on the outside of these buildings. So like Walmart's, in fact, have these a lot of times. So, you know, those are the Bloom energy boxes. They produce grid power. They also produce power dedicated to buildings or you know, office buildings and structures and things like that. But the one thing I like about the Bloom story is they're kind of the early days were like, hey, they put Bloom boxes by Google and Facebook and, you know, various tech shops where they're kind of their first customers, and they expanded to Walmart and things like that. Well, now they're starting to do grid. So they're basically saying, look, how do we stack energy, and how do we, you know, create a power plant basically? So they're starting to do these grid-based systems, which emulates the electricity which would otherwise be generated from a power plant. So, and they're starting to get some headway on stuff like that. That could be a huge growth vehicle for them. They started doing that in the last couple of years. So, so yeah, I mean, I think that's it's just a really cheap sort of growth name long term. So, you know me, hey, you know, I usually wait. You know, you get into these steep sell-offs. I'm usually waiting, but you know, you get a little curl. Again, the chart's curling up. You got a pretty good little short-term candlestick pattern there. So, you know, I'm firing it, just, you know, very modestly increasing my position in that name.
All right, got to ask you about CLDR a little more specifically. I believe they have earnings, what, tonight? This week, I think.
I think it's tomorrow.
All right, let me look at that for sure. But here we are now trading down below $9. Okay, so Wednesday afternoon, so that's tomorrow night. Yeah.
So again, CLDR is basically the antithesis of like, you know, MongoDB and Veeam and you know, whatever cloud stock you want to say. It's you know, my view, they haven't really produced reports that have been massively disappointing. I think that the market's view is, why would I buy a stock? You know, I'm not thinking this way. I'm just kind of thinking like, I guess, an Uber bull on VEEV might think. You know, why would I buy a stock with 22% growth when I can buy a stock with, well, VEEV's not a good example because they have 25% growth. So I don't really know why people would pay 26 times for VEEV and only 3 times for Cloud. So let's use one of my old favorites with my focus list name. Let's use Okta. Okta's 28 times sales. So you know, the growth guys would say, well, hey, I guess I'd much rather pay 28 times sales for a company doing, you know, 49% growth than pay 3 times sales for a company doing 20% growth. And that works. That can work in a kind of the market we've had. That's obviously worked better short term. Now, I'm not going to toot my own horn too much, but I was on the stock at 26. I made a lot of money on CLDR personally, or on Okta personally. And I do like the company long term, but there's just no way in hell I'm going to pay 28 times sales for it. There's not, you know, there's not a multiverse version of myself that's going to pay 28 times sales for Okta. It's just not going to happen. So, but that's, you know, that's the market we've been in. The market we've been in is much more willing to pay. I guess they just ignore it. They ignore the valuation of these names in favor of the short-term price action. They want to buy a stock in the upper right corner of a chart. So, you know, so we'll just see what happens. But, you know, I will say that you've got, I'm trying to think of the name. You know, it could be like NTNX got hit this quarter. You know, last quarter I want to say they got hit, but they bounced a lot off of the low. God, there's a stock I'm trying to think of that's a good compare. I'll just use Ring. A good historical compare might be Ring. I actually put this in a note yesterday when I was talking about ZUO, but it's, I mean, all these things are the same. Dropbox, ZUO, Pivotal reports, are they tonight? Yeah, Pivotal's tonight. Market hasn't really liked Pivotal. Pivotal's been produced a lot of good reports. Again, just a lower growth rate, so therefore nobody wants to pay much for it. Therefore, it probably is trading at a far lower valuation than it should. Again, Pivotal could miss. They could drop 20%. I don't know. I'm not worried about the company long term. But back to sort of just CLDR versus the more expensive names. You know, hey, I honestly don't know. You know, why were people willing to pay $214 for Facebook last year? You know, they were willing to pay it. That's not looking real good right now. You know, they were willing to pay $300 for NVIDIA. Stock's 130, 140. Not looking real good right now. At the same time, if it happened to be the person who was buying it at 50 and wrote it to 300, well, they did a great job, and their portfolio should be congratulating them, you know, all the way to the bank. You know, the fact of the matter is, though, very few people that were probably in CLDR at 300 were buying it between 35 and 50. You probably have a microscopic number of owners that bought it at 35 to 50 that still had the stock at 300. So the vast majority of the people that owned it at 300 probably were buying it, you know, 250 to 285 or something like that, or they were buying it 292. So anyway, we'll see what happens. But like I say, I kind of line up CLDR. I think the runway for growth is pretty long. If you look at something like a Ring Central, again, I never monetized that hugely. It did make very good money on that a number of times. Made at least 2x on it, at least once or twice, maybe even 2 to 3x once. CLDR is a little interesting though. They actually accelerated their growth. So their growth rate, like when the stock was a 4 or 5 year old company, was actually higher than it was when the stock was and this is publicly traded. So in the first year or two, Ring Central, I don't remember them being a 34, 35, 38% grower. That's what they've done in recent history. But, you know, Ring Central got cut in half twice, at least twice. Might have been cut in half 3 times. But, you know, every time the stock was sort of low teens, around 10, you know, I was kind of wading in there, buying it. That was back in the days. I also had some of the higher growth names like Workday and Splunk. Those are my two favorite names. But I don't know, Cloudera got cut in half twice. Again, maybe more than that. Traded kind of tough. You had to kind of trade it, kind of had to gut it out. Did produce some pretty good moves, 50, 80, 100% a couple times. I think I exited that stock probably in the high 20s, low 30s, maybe had a trailing piece of it into like the mid to high 30s. And frankly, it kind of became dull until it kind of just went up a lot. And that name ended up going up a little more than 10x off of ultimate lows. But like I say, Ring was never a super exciting. They wouldn't blow out numbers. The beats were like 1-2 cents instead of 8 cents. Again, it wasn't a 50, 60, 70% grower, which people tend to kind of gravitate to early on. Again, I think it was more like high teens, low 20s, maybe mid 20s in the first 2-3 years they reported. And, stock ended up doing pretty well. And so that's the one thing I would say. Now, we'll have to see what the report is on Cloudera tomorrow, and then we'll have to, there's definitely an odds that the report was not perceived well last quarter. A lot of times you don't get a healer report following. Sometimes it takes that one extra report. Although, to me, it's kind of a coin toss. Maybe they have good things to talk about with the integration with Hortonworks. One of their competitors basically just gave up. That company's been having problems for at least 4 to 6 quarters, though. But, they have one of their competitors, kind of a smaller competitor. I think they do something like 150 to 200 million annual revenues, maybe even a little more. And they basically gave up, couldn't get funding. I don't know if that's going to help Cloudera this quarter, but they should be able, those revenues should migrate to Cloudera over time. I'd say over the next 4 quarters, they probably kind of soak up that particular company's name is Mapper, private company. They probably soak up those revenues over, again, 4, 6, 7 quarters, something like that. Mapper is still a going concern. I think they laid off like half their workforce or something. So they could retain some of those revenues for a while too. But we'll just have to see. Again, the market just hates value. So, if this is an inline report, could the market sell it off? I suppose. There's a lot of things I don't understand short term. I don't understand why ZUO went down 35% on a 6% guide down. That doesn't make a whole lot of sense. Even a pretty bad. I've seen a lot of 6% guide downs get punished with sort of like I think the right amount would be 12, 15% down if you miss 6%. That makes sense. I'm not saying even that's right, but at least that kind of makes sense. 35% doesn't really make sense. But in the context of the market we've had, full-fledged buyer strike, very worried markets, trade this, trade that. Again, it's just really the absence of buyers. You get a massive buyer strike, so you get a free fire zone on the short side for the machines. So in a market like that, yeah, I guess a minor miss can result in a 25 to a 35% decline. So we'll just have to see. Like I say, Cloudera, if the stock's 550, probably not going to sell it. If the stock's 1250, probably not going to sell it. So, we'll just have to see the quarter, see what happens. I'm probably going to own the stock for like another 2 years, if not longer.
All right. So the last one I'm going to ask you about is Infinera, INFN. We had a downgrade from JP Morgan, I think, yesterday, and the stock rebounded off its lows, put in a low below 3, actually. I was really hoping it would close positive. It's positive today, and it's really on my radar as something that I may be getting into. I know you've talked about this one quite a bit, but what's your take here now in that low 3 level in Infinera, INFN?
Well, I think it's right about the price. Give or take 10 cents or something, or 15 cents. But I think it's right around the price that I swapped again, what I call my stock in lieu of leap. So when I buy a penny stock, it's usually in lieu of a leap. I think I bought Acorn and sold Acorn. Frankly, I think I got lucky to make money in Acorn. I bought a very good low price. But that thing was pretty dicey even for me, because I typically go for stuff that has a lot of balance sheet quality. By the way, like CLDR, I'm not going to spend any time on this, but they have a great balance sheet. I mean, I think they're only trading like 5 times net cash or something. So anyway, moving back to Infinera, their last call was really good. I mean, so again, you had sort of a minor miss and a bit more of a guide down. So it was kind of one of these things where, honestly, I didn't really think the stock would drop a whole lot more in that quarter. And I can't even remember. I'd have to go back, and I'm trying to find the report date. Was it that 420 gap? I mean, it was actually, if that was down in the quarter, that's a huge drop. I mean, to me, this is almost kind of like a ZUO type drop, because the commentary in the call was excellent. Their full year guide was barely lower. They did lower the full year guide a smidge, but maybe just a couple %. Next quarter's guide's not real good. But this is what I talked about the last time we were on, is that, like with this Huawei stuff, the market was basically getting it both ways. So the companies that had no exposure to Huawei had dropped just as much as the companies with the most exposure to Huawei. Again, this is just a group trade. This is a machine-based algorithmic group trade, pushing everybody down or stocks down, forcing everybody out, trying to execute as many stops as they want. They're not going to take my stock away. So, the bottom line is you had very good commentary. Full year guide kept relatively the same. This I think I've said this the whole time though. This is one of my least favorite fiber optic names. My least favorite fiber optic name is AOI, Applied Optical. This is probably my second favorite of the least favorites. But that doesn't mean it couldn't be a $6 or a $7 or an $8 or $12 stock again. So if Huawei is fully neutered long term, which I kind of don't believe it's going to be, but let's just say they are, my price target in this is way too low, because Infinera and Ciena are going to pick up a massive amount of business over like a 3, 4, 5 year period of time, as will Adtran, as will CommScope, COMM. If Huawei is just sort of partially curtailed, let's say Huawei loses 25% of their North American business, 15% of their European business, and not much of their Asian business, that still could be a pretty big boost for Infinera and Ciena long term. So we'll just have same thing. We'll just kind of have to see. I kind of like how it's basing. I think it had kind of one of these crazy gaps lower. Again, the crime didn't really fit the punishment. I didn't think that quarter was that bad. If they put it this way, if they don't guide down again and they meet their full year guide, the stock is probably worth 100% higher. But again, this is a $3 stock. I'm not personally going to put a ton of money in a $3 stock. I'm just not going to. I don't. Once stocks go below $5, man, they get weird. And history is littered with a lot of stocks that looked great that were $2.50 stocks. At the same time, one of my biggest all-time winners, well, it's probably my biggest all-time winner percentage-wise, nothing else even close. I bought a lot of Finisar in 2008 and 2009. I think we talked about the story. I thought I was a genius buying at 6 because the stock was like, I don't know, 35 or 40 about 2 quarters prior. Then I thought I was an even smarter genius buying it at like 4. And then with what money I had left to buy, I think I bought around 250. The stock, and that wasn't the bottom. I don't even know. Somewhere 120, 150, 180 was the bottom. But I'm not exaggerating this at all. I was selling shares of this company between 35 and 40 about 2 years later. It was either early 2010 or early 2011. Finisar hit $40. So you can get penny stocks, which, especially when they're actually a real company. Infinera is a real company. It's got close to $1 billion in sales. The balance sheet's not nearly as I used to love Infinera a couple years ago before it went. I think it went from like 6 to 20. I caught part of that move. The balance sheet used to be a lot better, but the balance sheet will heal up once they start producing higher revenues, which results in cash flow break even and positive cash flow. You know, they basically, the balance sheet got hit when they bought a company. And they bought they bought a lot of revenues for very low dollars. I think they paid 0.4 times sales or 0.5 times sales for this optical vendor that they bought. And so I think that same thing. I think that merger will pay dividends over time. They're probably having some digestion issues right now. I don't know. We'll see. I mean, I have it. I like it. I like it enough to own it in, I don't know, let's say I probably own this in roughly 1/3 the size of what I would own like an IIV and a Light and, you know, the names I favor, right? The names I think are kind of the better names in the space. So I'm just not going to get huge in a penny stock. I will say this, though. This is a stock I can buy higher. I would have no problem buying this thing 380, 420, 5, 6. We'll see. I mean, it just depends. It depends what kind of acceleration we get out of them. But I think they're going to see a pretty good order uptake. I think that, you know, we're still in early innings. It's easy to kind of forget the world that we're in, meaning 5G is still, we've probably gone from pre-game warm-up to inning one now. We're probably inning one of the 5G deal. So it's easy to kind of forget that 5G is a super positive catalyst when you have a lot of stocks down 20 to 30% off this Huawei trade war deal. But it's not going to change global end market demand at all. It's just, it's kind of a violent hiccup in the middle of it. And so there you go. I mean, it's like I say, it's one of the many names in the group. The one thing I will say, though, it's a vendor. It's not an optical component supplier. So sometimes, you know, when you get the vendors can put in pretty big moves once things turn. You know, these guys hook into a couple big contracts with companies that didn't, again, that were maybe using Huawei, cheaper Huawei gear. You know, that can move the needle pretty huge for a shop like this. So we'll have to see. You know, Sienna is another easy one. Again, I haven't really favored Sienna much. Sienna's had a pretty big drop too. I mean, Sienna, what was the year high in Sienna? Geez, 45. I think I was kind of calling people buying it there a little crazy. But I mean, you know, same thing. Sienna literally does almost no business in China, and is probably one of the companies best positioned to get business from Huawei. So, and yet, okay, so the stock was 44. It was 33 the other day. Does that make any sense? Not really, but they sold everything off. So, you know, prices went down for everything kind of across the board, especially in the mid and small cap range. So, but yeah, no, I think Infinera is fine. I don't know if I'm really going to buy it more. That last piece, when I swap my Acorn into it, that might be the last piece I buy, at least low. I might buy it on the way up. In fact, that's probably my plan now. My plan, in fact, for most things from here, kind of like post-December. I still want to buy stuff cheap, but I don't mind buying stuff on the way up.
All right. I think I might get involved in this INFN in the not-too-distant future.
So why do you like it, Mr. Jim? What is your thesis?
I'm basing it on a technical, and I'm liking this one as a low-risk setup. I like how it rebounded from that downgrade yesterday, JP Morgan downgrade. I look for those a lot. I look for those late to the
well, by the way, we've talked that could be a bottom tick, sure, right? Bottom tick downgrade. We always see those. And
I like it because I see if this thing breaks below 3 or 290, I'll get out of it. I'm not afraid to get out of it, whether it's you know, I mean, it's a 30-cent risk for a lot of upside here. I like it. I think that it has the potential to break out of this consolidating zone. It has the price action that I wanted to. It didn't quite do what I wanted to yesterday, but over a 2-day period, it did. And so, therefore, I think I'm going to take a shot at this one. It's a very compelling.
Well, you know,
it's a very compelling risk-reward setup, and that's a big part of my game.
Yeah, I like I said, I look at these as like, okay, I could go buy leaps on some other stocks, but in the absence of leaps that I think are fairly priced. By the way, I've tried. The BIDU options are still incredibly expensive. So like even things like 20 points above are quite a bit higher. So anyway, you know, I kind of like it in lieu of a leap play. The one thing I would say about Infinera, usually companies, you know, Infinera didn't die in 2008-9, right? And then as you know, we had that really kind of ugly period for kind of U.S./small mid-cap stocks in 2011, 2012. You know, it didn't die there. And then 2016 was pretty ugly. It didn't die there. So, you know, it's probably worth looking at a monthly chart. That doesn't mean it's going to go to all-time highs, but, you know, this was once a $4 stock that went to 25. You know, this was once a $7 stock that went to 12. It was a $6 stock that went to 12. You know, it was a $569 stock that 4 months later was 10. So in other words, you know, this company hasn't been killed off in really tough periods. So my guess is they're probably a survivor. There's always a risk of insolvency. There's always a risk that a company might. But I would say the absolute worst case for Infinera, but somebody would just buy them. You know, you'd get a takeout price at kind of a crappy price, but it would still be a pretty good premium over where they're selling recently. But you know, so you're probably your worst case on a company like this is they face consolidation. But like I say, they've been a survivor. They've produced some big moves in the past off of periods where everybody thought it was the worst stock in the world. So yeah, I mean, like I said, I don't really worry much about their long-term viability. I just don't know when exactly they produce the big move. So, but yeah, I think you're basically right. I think it's relatively low risk. I mean, put it this way, it's probably relatively low risk for a penny stock because penny stocks carry pretty high risk. But I would say for a penny stock, this is probably one of the better quality penny stocks you're going to find.
Well, if this thing is insolvent, I'll be out long before there. So,
oh yeah.
Anyway, TECHT, as always, thank you so much. And you know, we'll have a lot to talk about next time. I'm sure we'll get an update from you on CLDR and a couple of the other names that report later this week. And of course, we'll have you back on next week to have an update.
All right, take care.
Thank you.
All right, bye.